For most of us, tax season is all about that Form 1040. You get it done and you move on. But for some people, that's actually just the first step. There's this whole other kind of hidden layer of taxes that can pop up in very specific situations. So today, let's pull back the curtain and take a look at this world of additional taxes.
So here's what we're going to cover. We'll start with a strange parallel tax system that can affect high earners. Then, we're going to look into a rule that was made to close a tax loophole involving kids. And finally, we'll get into the surprising tax duties that come up when you hire help around the house.
All right, first up is something called the Alternative Minimum Tax, or AMT. I know, the name sounds pretty intense, but its original goal was actually really straightforward. It was created to fix a specific problem that lawmakers noticed in the tax code. So, think about this for a second. Back in the late 1960s, the answer to that question was yes, it was totally possible. Some folks with really high incomes could use so many deductions and tax breaks that their final tax bill was tiny or sometimes even zero. Congress decided that wasn't right, and their solution was the AMT.
The best way to think about the AMT is like it's a parallel tax system. It's almost like you have to do your taxes twice. You do them once with all the regular rules. Then you do them a second time with the much stricter AMT rules, which don't let you take as many deductions. And then you have to pay whichever tax bill is higher. That's really the heart of how it works.
So, who does this actually hit? Well, as you can see, the exemption amounts are pretty high. For 2024, a single person gets an exemption of over 85 grand. For a married couple, it's more than 133,000. What this means is, if your income, under these special rules, is below these amounts, you probably don't have to even think about this tax.
But certain financial moves can push you into AMT territory. It's usually a mix of high income combined with a lot of deductions that are perfectly legal under the regular system, things like state and local taxes. Other common triggers are things that give you a big tax break, like exercising certain stock options or cashing in on some large capital gains.
Okay, now the actual math is pretty complicated, but the concept is what's important here. You basically start with your normal taxable income, but then you have to add back a bunch of those deductions that the regular system allows, but the AMT system says, nope, can't do that. After you subtract your AMT exemption, you apply the special AMT rates. This gives you what's called a tentative minimum tax. And here's the kicker, if that number is higher than your regular tax, you owe the difference.
All right, so our second tax also deals with closing a loophole, but this time we're shifting focus from high-income earners to their kids. We're talking about the kiddie tax, and it was designed to stop a pretty clever tax-saving strategy some families were using. So here's how this little trick used to work. A family could gift investments, like stocks, to their young child. Then, when those stocks paid out dividends, that income would be taxed at the child's super low tax rate, which was often zero, instead of at the parent's much higher rate. It was a pretty simple and effective way to shelter investment income from taxes.
So to shut that down, Congress came up with the kiddie tax. The idea is actually pretty simple. If a dependent child has too much unearned income, that income gets taxed at their parent's higher rate, not their own. This pretty much gets rid of the whole reason to shift income in the first place.
So what's too much unearned income? For 2024, this is the magic number you need to remember: $2,600. If your kid's unearned income is below this, the kiddie tax generally isn't an issue. But once you go over that line, the new rules kick in.
Now, this next part is absolutely critical. The kiddie tax never applies to earned income. So we're not talking about money your child makes from a summer job or mowing lawns. It only applies to unearned income, basically money that their money makes, like interest from a savings account, dividends from stocks, or capital gains.
So why that specific number, $2,600? Well, it's not random. For 2024, the first $1,300 of a child's unearned income is totally tax-free. Awesome. The next $1,300 is taxed at the child's own low rate. It's only after you pass that combined $2,600 that the parent's higher tax rate takes over.
Okay, and that brings us to our final topic. And this is one that is way more common than you might think. We're going to talk about the nanny tax, which, by the way, isn't just for nannies. It can apply to all sorts of help you hire for your home. So let me ask you this. Have you paid someone to come to your home and work? A regular babysitter for the kids, a housekeeper who comes once a week, maybe a caregiver for an elderly parent? If you said yes, well, you might have accidentally become a household employer without even knowing it.
The really important thing to understand here is what makes someone a household employee.
The key is control. If you control not just what work gets done, but also how it gets done, like you set their schedule and you tell them how to do their tasks, they're probably your employee. This is way different from an independent contractor, like a plumbing company, where you don't control how they do their job.
And for 2024, this is the number you need to burn into your memory. If you paid any single household employee $2,700 or more for the entire year, you were generally on the hook for paying employment taxes, like Social Security and Medicare. That, in a nutshell, is the nanny tax.
But, and this is a big but, there are some really important exceptions. You generally don't have to worry about these employment taxes if the person you're paying is your spouse, your parent, or your own child who is under the age of 21.
Okay, wow, we have covered a ton of ground, haven't we? From parallel tax systems to kitty loopholes and nanny taxes. So let's just pull everything together with a super quick recap of the most important takeaways. So here it is, all on one screen. The AMT is that parallel system for high earners, and you start thinking about it when your income gets above those pretty high thresholds. The kitty tax looks at a child's investment income, and the magic number there is $2,600. And finally, the nanny tax kicks in when you pay a household employee more than $2,700. 3 really different taxes for 3 really specific situations.
So, at the end of the day, the biggest takeaway is that our tax system has way more layers than most people realize. These extra taxes are a good reminder that certain financial choices require a much closer look. Which brings us to our final question for you. Now that you know about this hidden layer, will it change how you think about your own financial plan?